Hi, very good morning to everyone out there. Benjamin here speaking. So I'll kick off today's webinar with our take on SGX first, as they are releasing their results tomorrow for the first quarter of their financial year. Okay, so SGX at the start of this month, they released their monthly statistics. So this is a pre-earnings report that we have issued last week. Right, so if you monitor the securities daily average value, or SDAV for short, right, for the last quarter wasn't too bright. It hit a historical low of 0.97 billion for the first quarter of FY15, right, which is the third quarter of this calendar year. So if you have been tracking as well, the trade volumes for securities were quite depressed over the last quarter. So we have seen a decrease of about 14% Q on Q, and year-on-year wise was even worse, 27% down. Alright, so this quarter again is a quarter of very depressed trade volumes. So going into the final calendar year quarter, right, of 2014, I think this trend should continue to be present, as the second quarter of the calendar year is usually a seasonally weaker quarter as well, right? And then following that, for the derivative side, right, it was a very good positive that taken away this quarter. Right, the volumes have grown 9.4% Q on Q. Okay. Testing. Can you guys hear me? Testing. Hi, to the audience out there, can you guys hear me? Testing. Alright, so we are continuing. I think for most of the audience out there, we are able to receive our audio feed. Alright, so continuing on the derivatives business. Right, so again, Q on Q, we have shown a 9.4% growth. Alright, so it's a big positive that we took away this quarter. Right, if you analyze the breakdown of the derivatives growth, we saw very exceptional volumes from the China A50 contracts. So Q on Q wise, there's a phenomenal 60.5% growth. And year-on-year wise, the volume actually jumped more than twice. So the growth this quarter was largely driven by the A50 contracts. Right, so if you compare that against the security side, usually in the past, securities to derivatives revenue usually had about a ratio of 3 to 2. Right, so over the last half year or so, the securities and derivatives revenue has been on par 50 to 50. Right, so going forward, I think with the weak securities volume, right, but it's getting made up by the derivatives revenue portion side. Derivatives revenues should be in the lead, right, in comparison to the securities business. Right, so on the expectation side, the securities revenue should continue to decline, right, as the SDAV has really slipped 14%. Right, but the key thing is that the impact should be quite cushioned, because the average clearing fees have been revised as of 1st of June this year. So the cap trades of trades above 1.5 million in value, right, the fees have been revised, so the cap trades are no longer present. Right, so all the trades will be priced at 3.25 basis points. Right, derivatives revenue should be stronger as well, since the volume has grown. Right, and the key thing is also last quarter we saw quite a phenomenal amount of IPOs. Right, so last quarter 1.9 billion was raised. Right, so because of all these factors, we trim our FY15 and FY16 EPS slightly downwards by 3% and 5% respectively. So our new target price is $7.30, and SGX we have upgraded to accumulate, considering the price correction, and we see more than a 10% upside. Right, so dividend yield currently is very attractive at 4.4%. Right, and SGX usually pays out between 90 to 95%. That's our payout ratio for dividend. Right, now I hand over to Colin to talk about M1.
Hi, morning everyone. For M1 has released its third quarter earnings last week, and I'll just give an update on its quarterly performance. Right, revenue has been up. Hi, testing. Can anyone hear me? Right. Okay. I believe some of the audience are encountering some problems with the audio. Um, right. Okay. Apparently, it just extends to some of the audience. So I'll just carry on. For those that can hear me. Right. For the quarter, revenue is has been up due to a boost in mobile and fixed services as well as handset sales due to a strong interest in the iPhone 6 and 6 Plus. Right. However, international core services revenue has been on the decline. And that was mainly due to a lower retail traffic. Right. So mainly on the mobile side, postpaid revenue has been increasing, and that's the main growth contribution to the mobile revenue due to a higher subscriber base as well as a higher ARPU due to higher mobile data usage, and which leads to more subscriber exceeding their data allowances. Following Singtel's lead, M1 has also has announced that it will be waiving off additional charges on its 4G permanently in the future, right? And it has actually revised its postpaid plans with slightly higher pricing of about $2 per month since September, along with the launch of the new iPhone 6 and 6 Plus, right? Postpaid subscriber, however, has contracted 1,000 in the third quarter. However, we think this is not too much of a concern, as management has guided that they'll be focusing more on the top line growth rather than the subscribers volume growth instead. And so hence we'll still keep lookout on this number, right? So and on the prepaid side, revenue has been down, and that was due to the continuing impact from the regulatory change, which was introduced in April in this year, whereby the quota for the prepaid cards for prepaid customers was reduced from 10 to 3. Right. So on the international core services, this is in line with the trend that is faced by all the telecom operators, whereby the telecom operators are facing a lower retail revenue due to a decline in international retail minute as they face a substitution from alternative channels, mainly posed by OTT, Skype, and such. Right. Also, on the positive side, they also have lower traffic expenses, and they have also seen improved margins due to a lower cost of sales, which was also helped by lower handset subsidies. So EBITDA on service revenue margin has in fact improved to 40.8%, which was a great significant improvement as compared to the third quarter margin of last year of 37.6%. On the fixed services segment, fiber customers has continued to increase due to a take-up of fiber broadband plans from offered by M1, and the ARPU on the fiber has in fact improved due to expiry on some of its promotional discount, right, or on that was offered on its fiber broadband plans, right. In our view, we still see that growth fundamentals remain firm, and mainly the growth of M1 will continue to be driven by rising mobile data usage as well as increasing fiber broadband subscription. So these will be the two main drivers that will continue to drive growth forward. And due to the impact of from the recent market sell, we see that in fact the decline in the stock price has presented quite a good buying opportunity, right? So on the key downside risks include further decline in broadband space, as well as a potential new entry to mobile in the mobile telecom space. So we are maintaining our earnings estimates in FY14, as well as our target price of $3.95. So hence, due to the drop in the share price, we think that this will present buying opportunity, and hence we upgraded our rating to buy, right? At current share price, this implies of about attractive dividend yield about 4.7%. Right. Next, I'll hand over to my colleague, Yong Kai, who will present on FNF Ventures Group.
Okay, just give us a minute. We'll be continuing very shortly. Thanks. All right. Okay. So this is Yongka here, the analyst for US equities. Okay, we'll just continue from here. If there's any problems, okay, we really apologize. Then you probably have to refer to the archive that will upload this entire webinar recording to the Philip website later. Okay, so again, this is Yongkai here, US equities analyst. Today I'll be talking about FNF Ventures Group. It's an undervalued new spin-off that we issued an initiation report just 1 month ago. So to recap, the share price is actually at the low end. It's almost at the 52-week low of $13.05. Diluted market cap is $1.2 billion. So it's actually quite a decent sized company. Price over book value is 0.83 times, which at first glance might not be that attractive, but actually what we think is that the book value is understated, and the PB ratio is actually lower than what you see right now. Okay, some quick background. This company was spun off from Fidelity National Financial with a stated strategy to monetize the portfolio companies, because these investments are all of a very diverse nature. There's automobiles, that's software, and that's restaurants. So the parent company, which it was spin off from, is the #1 US title insurer, previously part of a bigger conglomerate which the executive chairman broke up in 2006 and 2008. This guy actually has a very excellent track record of creating shareholder value. Through M&A, he's grown revenue from 40 mil in 1984 to 15B 30 years later. Of course, you might think that, you can do it through shares dilution, that it might not be anything substantial, which I agree. But if you look at the share price from 1998, which is the latest record that we have, from 1998 to 2014, the overall share price actually increased by 25% compounded every year. Okay, right now they also have this long-term investment success incentive program in place. So beyond a certain ROI threshold, which is 8% in this case, 20% of which will go into this incentive pool to reward the managers and executives. So the last line, which is what we count from the regulatory filing SEC, our strategy for the FNFV group will be to achieve superior financial performance, maximize and ultimately monetize the value of these assets. So this is a stated strategy. We'll just quickly gloss through the portfolio companies to see what they could be worth, and then we'll sum them up for the sum of the part analysis. Ceridian Holding LLC is a 32% stake in it. This consists of two parts. One is a leading provider of global human capital management and payment solutions. The other part is innovative payment solutions. This Comdata, which is the one that provides the payment solutions, actually was sold to FleetCor recently for about $302 million as of 17 October. Okay, what is interesting is that the combined stake was previously carried at the $332 million after a write-down. So if you actually add up the FleetCor shareholdings from the Comdata sale and you add our implied valuations for Ceridian HCM, you get a total of near $600 million, which is almost double that of the original carried cost. And that's very recent, 30th June 2014. So this is the first hints that the companies are all carried at below the actual market value. American Blue Ribbon is a 55% stake in the 8th largest full service restaurant. So what happens is that it built up this stake at a total cost of $110 million. The EBITDA margin is actually way below the competitors. Darden Restaurants is actually a very openly known distressed restaurant play, which owns the famous Red Lobster chain, which they have since sold for about $1+ billion. So Darden Restaurants, even though it's distressed, is still earning 9% EBITDA margin. Cheesecake Factory, if you have traveled to the US before, you actually will be very familiar with it. They're earning, of course, a much better 12.8%, and we think that based on this comms, there's room for improvement. If you just assume a 8% EBITDA margin, which is below both the peers margins, and use an 8x multiple, then the equity stake alone will be worth about $429 million, which is way above the cost 110 mil. J. Alexander's, okay, so this could be worth about $136 million based on the current EBITDA margin without improvement and a 9x multiple. So what happens is that on the day that we issue the reports, it actually filed for preliminary paperwork for IPO, which can be used, which will be able to substantiate and validate our valuation assumptions. Remy International, 51% stake. This is a leading worldwide manufacturer, a remanufacturer, distributor of starters and alternators. Basically, it's like vehicles and automobiles. Our chain invested in it when it was in bankruptcy 2007. Subsequently bought another 11.4 million shares for a total cost of $156 million. Today, they're worth $308 million at the closing price. What is interesting here is that on 8th September, the company actually announced that they'll distribute this stake, all of this stake to the FNF shareholders. So this will work out to roughly $3 plus per share versus the share price today of $13. That's more than a 25% special dividend yield. Digital Insurance is actually mainly just a distributor of insurance and benefits management. So we are based on all these assumptions, we are looking at the peer group and we're looking at the EBITDA margins. So FNF carries it on the books at 8x EBITDA, which we think actually could be worth higher 10 times. So based on that, the equity stake plus the 58.5 mil debt that it owns, it will be worth $160 million. Okay, we'll just continue. Cascade Timber. Because Cascade Timber actually, what it has is a 70% stake in the nearly 200,000 acres of Oregon timberland. Based on the public comms will be and the capital structure, we think that the 70% stake could be worth around $78 million. But the thing is that after you harvest it, some of the acreages have actually been converted into residential use. So potentially this is more valuable, and you're actually recycling the real estate twice. Lastly, Lardner Investments originally carried $159 million original cost, based on 1x PB for the 15% stake in Stillwater, and applying a 50% haircut to the original cost. Then we have a total valuation of $100 million for this segment, which is below the $159 million original cost. I mean, we're just being conservative because for the other stakes, there's actually a lack of financial information here. So, okay, some of the past valuation. What we want to highlight is that since in the 4 months since the spin-off on 30th June 2014, this company actually sold this Comdata stake for about $302 million tax-free. Announced the distribution of Remy International shares, which is worth another $308 million, and filed IPO paperwork for the restaurant group. So again, the strategy is to achieve superior financial performance and ultimately to monetize the value of its assets. Because of the active management and unlocking value, we think that the holding company discount is unnecessary. And also, just to be conservative, we set aside $188 million deferred tax liabilities, which is based on the 35% corporate tax rate. even though most of its transactions has been tax-free so far. Of course, this provides some buffer as well. If our valuation is lower, then the deferred tax liabilities that's owed will be lower as well. So this will help to support some of the asset value. So this will be summed up based on all numbers we have derived just now, and then we have a subtotal of $1.5 billion. Since the holding company discount is 0%, target price will be the same, $16.26. You add this to the $3.04 per share distribution of Remy International shares, and minus a 30% withholding tax rate for this, you will be arriving at 42.5% potential return. Okay, this is assuming that you hold on to the share all the way until you receive the Remy International shares. Actually, potentially you can get away with it, because if you sell the shares one day before the ex-dividend dates and then you buy it back immediately, you might be able to capture some of the tax savings. Alright, so now I'll just hand over to Joshua.
Joshua here. Okay, just to address what's been going on in the market. So basically, global GDP has been rather good from the US, sorry. Hi. Sorry. Let me just start again. Basically, just to address what's been going on in the market, we think that this is a correction and not the start of a bear market. So far, in terms of global GDP, US data has been extremely good. China is in a structural retooling of the economy, so this slowdown is actually a good thing, and actually it would be bad if the economy was on fire. Okay, so we should get used to a China that slows down and basically gets rid of the excesses in the economy, namely the oversupply of inventory in the housing residential market and local government debt. Okay, and also what was previously a bloated manufacturing sector, and the Chinese economy is retooling. Okay, now the EU faces a lost decade, a bit maybe like Japan was 20-30 years ago. However, the main thing that's going to be positive going forward is that we have low crude oil prices, and I believe this is going to be an economic stimulus going forward. Net oil importers are going to have a boon: Japan, Indonesia, and India. Indonesia will have more wiggle room to end fuel subsidies, and in Australia, lower fuel prices means the excise tax also has less impact, which means greater chance of resource capex revival, as the excise tax is meant to be channeled into infrastructure. However, is this correction over? I think, speaking to Kenneth, we do have some positive indications that it could be. CRV test major support, bond surge shows exhaustion, high yield debt jump, S&P 500 bounces on oversold. In terms of breadth, the NYSE breadth indicator has crossed the 50 daily moving average, and as it has been oversold, and midterm elections usually have October bottoms. What has not been encouraging is that the small cap rally on Friday actually faded. So on balance, we think that we do have at least a short-term bounce. Okay, in this correction, here are a list of stocks that we think are good to buy. We have OSIM, which is cheap. It's got a growth story that's intact. PEX cash is just 11.6 times earnings, and it's got a war chest of 500 million. The stock is also oversold. Today it has jumped to about 220. We think that this is one of the good deals that has presented itself in this correction for what is pretty much a strong business model and premium brands in the OSIM brand, the TWG, GNC, all doing well, cash generative as well. and so we think 11.6 times forward earnings on a ex-net cash basis is rather cheap. DBS has improving earnings quality, it's disciplined trade finance, strong deal flow pipeline, solid funding base for a net interest income uptrend will drive a re-rate of the bank, current price at 17.90, target price 20.50. Balsted has seen a strong order book revival of high value added industrial buildings, which asserts a supremacy in design and build. Current price $1.71 half, target price $2.40. Comfort Delgro had record revenue last quarter on very broad-based growth, so we're very positive on this transport operator, and especially falling crude prices will benefit it. Current price $2.43, target price $2.85. I'll pass you on to Kenneth, who's got a comment on Valuetronics.
Hello, hi, Kenneth here. Okay, just give me a moment. I need to reply to some sound issues that we're having. Just give me a moment. Okay. Okay, hi. Kenneth here giving an update to Valuetronics Holdings. So last week was very dramatic for Valuetronics. It's like a drama. Essentially, what happened was the price of Valuetronics had dropped from 40 cents down to 30 plus cents. Rationale, well, the main reason is because there was a negative report by another research house that called for a target price of 25 cents. So this is just a very quick update to that. Our opinion is that the negative report is just too heavy-handed, and I'm just going to and although our target price is under review until the next quarterly announcement, right? I'm just going to address certain things about that report, which I think is just unfair. Okay, first of all, point one, they valued the LED business at 0 times PE and the ICE business at 6 times PE. We find that both these measures are way too unfair. Okay, rationale is this. They said they had claimed essentially that because of some change in structure of the major client, that they would likely lose. There's a high probability of electronics losing that business, and hence they valued the LED business at 0 times PE. Now that's very unrealistic, because based on what is publicly known right now, all we know is that this client is just changing the legal entity of the lighting business for strategic reasons. They never mentioned what else they were doing. They simply mentioned how they were doing this for the betterment of management, betterment of they had strategic reasons for doing so. Okay, they did not say they were cancelling out the business or things like that. So we find that to give a value of 0 times PE is highly speculative, and there's very little reason to believe that based on information as of today. Okay, now, but however, I do agree, and I have wrote down in my last report that I do expect competition that will continue to cause the earnings of the early business to drop. Okay, that is true of any product cycle. In this particular cycle, it may happen faster than expected. But even then, even if that's true, it cannot be 0 times PE, because you're going to have residual earnings for this segment for a couple of periods, right? So it cannot be 0 times PE. Second, it's also unfair to rate the I segment at 6 times PE simply because the I segment delivered record revenues with a widening customer base. In other words, it's becoming more diversified. And not just that, the ICE segment also has a higher than expected 17% gross margin, much better than peers, and has a robust double-digit growth rate year to date. It has grown roughly about between 20 and 30% year on year so far, and this year is expected to increase a bit more simply because they have already booked a new client in the beginning of the year, and those revenues have not been booked in yet. Hence, the possibility of a further increase this year is there. So because of more visible earnings, good margins, and a more diversification in its earning base, it's also unfair to rate that particular segment at 7-8 times PE. Okay? Yep. So anyway, so far for the year, we think that the ICE segment growth will buffer the CE decline with, and you most likely, maybe you end up with a flat net income growth. Now, if that's true, okay, then at 33.5 cents, which is yesterday's price, and based on expected earnings, which is flat to single digit, right now we are looking at a PE of 5 times, okay, and a PE X cash of 3 times. So we believe that even though target price under review, it's still undervalued in view of the present available information. Okay, so now we are having the question and answer time. Please go ahead and ask your questions. Okay.